£2,000 each, gives you £10,000. So you would have sold 5 laptops to break even. So where your total sales equals your total costs. Yeah, where your total sales equal your total costs. Okay, let's switch it off, please. And if we look at the chart, we can see the chart there where the fixed costs go parallel and the variable costs, and where they combine, sales per unit and the total cost and the fixed costs combine, then where they meet would be the break-even point. If we were to look at the formula of that, the formula is the total cost on top, or total or fixed cost on top, divided by your contribution. Your contribution is worked out by the selling price minus the variable costs, or the variable costs. So you've got your total cost or your fixed cost at the top divided by your selling price minus your variable costs, and that gives you your break-even number of units you need to sell in order to break even, to come to zero. Okay. So we need to do what now? After we explain the break-even analysis, what do we need to do then? Good. We need to look at the advantages and disadvantages. So what are some of the advantages of break-even analysis?
It gives assistance in decision making to decide whether to reduce price.
Yes, it gives you an enabled decision making to know that when you've actually met your break-even point, you know that your costs are covered. Yeah. And so then you can know that for the rest of these units, this is going to bring in X amount of profit. And it also tells you, well, all this is now profit. If they're selling slowly, you might want to say, let's reduce the price a little bit now. This is all profit here to get the cash in.
Yeah.
Okay, it allows you to make that decision. Okay, so what are the disadvantages?
Tell me the amount of
There's a fixation on selling price. The selling price is kind of fixed because then once you know the selling price, then you know the variable costs, then you know the contribution. So you know how much you're going to get. Okay, it's not based on the selling price varying. It's based on a fixed selling price. But normally you're going to know what you're selling something for anyway, aren't you? Okay. Okay. So what about some of the disadvantages of break-even analysis?
faulty assumptions.
Okay. Yes.
You can get unrealistic views on costs.
Yes, because as we discussed last week, absorption and marginal costing in the income statement, predominantly in the gross profit, how to calculate the gross profit, you had sales minus your cost of goods sold. Okay, your cost of goods minus your stock gives you your cost of goods sold. Sales minus cost of goods sold gives you your gross profit. And we said that in the gross profit calculation for absorption costing, it takes the cost of goods take into consideration all the costs, all the fixed costs of the business, which may not be necessarily attributed to the cost of manufacturing that product. Whereas marginal costing is broken down by the fixed and variable costs only associated with the cost of manufacturing that product. And the other fixed costs are put in the administration charges of your income statement. So that in your absorption costing, your gross profit margin is going to be less. Yeah? So if you're thinking about the break-even point and you've got other costs in there which are not or shouldn't be included in your cost of your product, then it's giving you, as it says, a faulty assumption in terms of what your break-even point is. It may be, if you're using marginal costing, you would need to sell less. Okay? Does that make sense? What are some of the other disadvantages? Unrealistic technique, yes. To use this in isolation can be a little bit limiting. Okay? What else?
Little firm.
Yes.
The size of the firm.
So this technique cannot effectively be used where a firm produces more than one product with the same plant and machinery and having different contribution margins. So it's very difficult where you've got multiple products and you don't know how you're going to associate the costs to that specific product line. And then to produce all these different break-even charts for every single product. So it's very, very difficult. If you've got one or two product company, then it's easy. But if you've got 1,000 products, Very difficult.
Very difficult.
Very difficult to associate the cost. And the thing is with break even, you need the total costs at the top, divided by your selling price minus your contribution, minus your variable costs. So to get the number of units, you need to break even. So very difficult if you've got loads of products in your company to work at the break even point. Okay? So we've looked at now, what is budgetary control. We've looked at what a budget is. We've looked at flexible budgets and static fixed budgets, good. And we've looked at break even. And with each of those, we've looked at the advantages, disadvantages. So what do we need to talk about now?
Cash budget.
Good. So now we're going on to specific budgets because, as we've said before, you can view the tools either as a budget, which is a tool used to control budget control, and you could use from one different view break-even analysis. But from another perspective, all the budgets are basically tools to control budgetary control. So we're going to look at two specific budgets. We could use any other budgets, and there's loads of them out there. So we're just taking the master budget and the cash budget. And we're going to look at what they are, and then we're going to look at the advantages and disadvantages of those. Okay? So, what is a master budget?
To collect data of all smaller budgets within the company.
Okay. Say that one more time.
It collects data of all small budgets within the company.
Yeah. So the master budget is a master. So you've got one main budget and you've got heads of departments and different departments. And with each manager, they may have their budgets. And all those individual departmental budgets feed into the master budget. So the master budget, what's the advantage of a master budget?
Isn't it they can be able to help to plan
Yes.
overhead?
Yes, you can be used to plan ahead because you can see everything. So the chairman, the CEO, can see every single department, knows exactly what every single department is spending in what areas, and knows what's happening where. And then with all those spending from all the different departments, he's also going to know the cash flow requirements of every single month. Because once you put it all together, then you add it all up, and you know exactly on this month how much cash you're going to need in the business for every item. Yeah?
And it also enables the company to know how much it earns. Is that right?
Yes. Well, the thing is, and then you can see how much you're spending, what you budgeted, and then you can see if the sales are coming in and the sales are covering everything. Because if the sales are not covering everything, then you're in trouble. So it allows you to have an overall picture of everything. What are some of the disadvantages of a master budget?
There's lack of specificity
Yes.
and hard to determine how much one is spending on a monthly basis.
Yes.
It's difficult to update.
Difficult to update and to change and to know how much money is being spent because, and to have all this information coming in and changing all the time from loads of a big organisation with loads of departments can be quite tricky. Could be a full-time job or a full-time team of people that needs to produce this master budget. And what happens if you guys, as heads of departments, don't give the information on time? Or what happens if you don't give the accurate information? Do you understand?
Yeah, sure.
So, and what happens if the information is not in there? Well, you haven't put through costs yet. And you haven't put it through in the department yet. Do you understand? Or you spent something and it's coming in later, which hasn't been anticipated for. Yeah? So it's difficult for the person controlling the master budget. So we can see some advantages and disadvantages here. Okay, and the other thing with lack of specificity, we're talking about this is an overall budget. It's not giving you on a month-by-month basis, really. It's an overall budget of everything. Okay, so it's not splitting it down for every single month and quarter, and it's an overall budget for the whole financial year. Okay, so we talked about master budgets. Now, what budget do we need to look at?
Cash budget.
Okay, so what is a cash budget?
it checking and ingoing and outgoing of?
Yes, all the money's coming into the business,
And the one that's-
and all the money's going out of the business. You know, if we remember the cash flow statement. Remember the cash flow statement? What 3 sections? Can you remember that picture?
It's right there, isn't it?
Yes, yes, it is there. So what's the 3 sections then? The first section is the operating expenses. Yes. Second section is the finances, and then financial investments. So you've got all monies coming in and out of the business. Okay. So you've got all the monies coming in and out of the business. Okay. So we know this is important to a business. What are some of the advantages and disadvantages of a cash budget?
Can identify any bankrupt, overdraft.
Yeah, you know, by looking at the cash budget, you can see if you're over, if you're under, and if you actually need in this month or that month to take out additional overdraft facilities or even loan facilities. Okay, what else? It identifies surpluses in cash.
Yeah.
Surplus in cash. If you've got too much surplus and it's just sitting there in the bank, then maybe it's not an efficient use of your resources, because that could be put into another ISA or into a bonds to actually give you more interest charges, because it's not necessary just to be stuck there in the bank. Okay, so